Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I've been talking investing today, and I want to share something with you, by the way. I've been going through the PowerPoints here with you and sharing some of the myths of investing so you'll understand some of the things that people get trapped in many times. And this is very commonly put out in the market. Unfortunately, traditionally with advisors and with the broker-dealer system, the way that the financial press, for that matter, a lot of these things are kind of, these myths are kept alive through this type of, through the way the mutual fund industry and other things work. Understanding, though, that doesn't mean that there are not ways to do this, but as we mentioned, there are 30,000 funds out there. Well, how do you figure out which ones to invest in? You know, when you're looking at all these thousands and thousands of choices, how do you make that call? Well, understanding the science of investing is how we're going to do that, and that's what I'm going to share with you this morning as well. But understand, too, I want you to, to share with you that part of this has been my own evolution through this process. When I first got my security license, which was over 20 years ago now, and I was doing basically working in a broker-dealer system, and my broker-dealer, I trusted them. They would give me this proven performer list. It was a list of mutual funds that we were to show our clients. They said, these are the ones that do the best. And I believed that wholeheartedly. I was like, yes, absolutely. This is a large company. They've got all the research tools. And I was so disappointed when it wasn't working, and I wanted to find a better way. And I thought, well, let me, I started doing my own research. I purchased software. I started constructing portfolios based on these, the best funds out there. And then I was so disappointed that that wasn't working either. And then I happened across a company, all right, Matt's Money out of Cincinnati, and this is a portfolio manager, and they're the ones that first started talking to me about going to a conference and learning about what we will, was called passive investing or evidence-based investing, which is basically talking about this science of investing, talking about portfolio construction. And that's when I started to learn a lot more about, and this is about 12 years ago now, I believe, started to learn a lot more about how the markets work and how then I could help my clients take advantage of that. And then since that, we've evolved even further. There's so many things we've been able to add, so much more research that's come available to us since that time, so we're able to even do more with regard to the portfolio. So a lot of the material I'm sharing with you comes from a company called Dimensional Funds of America. Great company out of California. They're one of that's an institutional indexed fund company, if you will. And one of the things you find, some of the largest investors utilize DFA funds. They really love them. Pension funds use them. But in addition, there are other tools out there. Vanguard ETFs, Vanguard funds, index funds. Keep in mind, Jack Bogle, when he founded Vanguard, that was about indexing. They created and were the originators of the index fund. And now, unfortunately, as Bogle himself has said, when they got away from that and got into active management, they went from being fiduciaries to being salesmen, all right? And that's what active managers. So understanding that even a great company like Vanguard as an example, or DFA, you've got to watch, you still got to watch fees. You got to keep your costs low. The other thing is you got to watch out about active management versus passive management, or by that simply meaning utilizing the research that's there to construct a portfolio. So I'm going to talk to you about why that's so important. It's in fact the biggest determinant of what type of return you're going to get and the success you're going to have in a market. It's not about stock picking and market timing and of course watching your costs or track record investing, but it's about asset allocation. But it's got to be done right. All right. So on the next one, what we're going to talk about, Mattson's free market portfolio theory is what he refers to it here. But basically, all we're talking about is the science of investing. In fact, if we look at the next slide, what the basis of that is, and what Mark found out when in doing his own research, and what it's put out through DFA, is this: free markets work. Understanding that, and this is the key, modern portfolio theory, which goes back again from the, Harry Markowitz won a Nobel Prize back in 1990, all right, and his research that predates that for about 15, 20 years. So if you look at the last 50 years, we know now where it works. And a three-factor model that was developed by Dr. Eugene Fama, who won the Nobel Prize in 2013 for his research. So who are these academics? Well, the leading academics whose ideas form the basis of modern free market portfolio theory, and we have, of course, Dr. Harry Markowitz, who I just mentioned, Merton Miller, both winning the Nobel Prize in 1990. That's on the next slide. All right. There we go. Those are our academics. That's 2 of them. And if we go on, we see that we have Rex Singfeld, who co-authored this book, Stocks, Bonds, Bills. Roger Ibbotson. Ibbotson is one of the, company that puts out a tremendous amount of research and great material for us to help us with this, again, when we're working with the markets and understanding, in particular, putting in perspective the ups and downs in the markets that occur. And then, of course, Dr. Eugene Fama, who won the Nobel Prize in 2013 with Kenneth French. And there we developed what's known as the 3-factor model, okay? Known as the father of efficient market frontier. So one of the things that is Dr. Markowitz developed the efficient frontier. So now we look at how free markets work. And this is the key to the whole thing. All right, if you understand this part, all right, one of the things when it comes to free markets, if you go, think of it this way: if I go to a Kroger's or Publix, to buy a gallon of milk, it's going to be the same, right? That's the markets at work. There's a competitiveness here. We know that if they're going to stay in business, they're going to have to be competitive. So that's the way that free markets price things. And that's the other part of that pricing, is whatever that cost of that milk is going to be based on all the things it took to get it into that shelf in front of you. And again, there's an efficiency to that. So we know that you're not going to go to Kroger and find something twice the price of Publix, okay, and vice versa. Not if they're going to stay in business, because we're going to go and chase that, right? So here's the other part. This goes to the beliefs that you have. If you understand this difference of whether and what your belief may be about free markets, this is what Mattson proposes here. So the potential belief that free markets fail. All right, the market fails to price goods and services efficiently. That somehow there's going to be things out there that you can find that no one else knows about, and you're going to be able to take advantage of that. There was a time, maybe 40 years ago, where that was more likely. In fact, Ben Graham wrote the book on value investing. He was teacher and mentor for Warren Buffett. But since then, even both Ben Graham before he passed, and Buffett has said in recent works as well, that the reality is that if you want to, that the best way for someone to invest in the market is to buy the market, is through indexing. All right, and we're going to talk about how to use institutional index funds to do that. All right, so free markets work. Next one, potential belief, free markets fail. If you believe this, all right, that it's possible for individuals to identify in advance what prices are inaccurate, underpriced or undervalued, that managers seek to, are going to be able to increase returns and avoid losses by taking advantage of these mispricings. That's if your belief there, that's what active management's all about. That's what they're saying. Yes. Give me your money and I will, go out there and beat the market for you. And what we see by the research we've already covered is they're not able to actually do so. So what's the next thing then? The alternate belief, easy for me to say, free markets work. All right, well, free market is the best determinant of market prices based on supply and demand. Right? Isn't that what it amounts to all the time? What are you going to buy? What do you want? What are the markets going to dictate? That has to do with what comes to market. It has to do with the pricing of what comes to market. It's all about that, supply and demand. All available information is factored then into the current price. So there are no, if it's known, all right, with a stock, this is the same thing, and this is one of the things that's Dr. Fama talked about as well, is that the value of the stock is built in. So whatever that stock's selling for, if everything known about it is there, then that's the case. If some new information comes available, the stock price will immediately reflect that as well. All right, so therefore, beliefs dictate actions. So if you believe that free markets fail, then active management is for you. If you believe that you or a money manager has the ability to beat the market through finding these mispricings, if you will, in the market, then that's the way you should invest. You should match up with your own beliefs on this. And the same thing, if you believe free markets work, and that you want to focus on capturing those market returns, minimizing your risk, your volatility in the process of doing so, then utilizing these asset class models and structured funds, that's where diversifying and understanding how to do that, then you would want to do that more. You're going to be looking more for what I do, in fact. because that's the way I believe. I believe free markets, in fact, do work. And when I look at the modern portfolio theory, when I look at diversification and I see the proof of that, and I see the Nobel Prize winners out there going back from 1990 to the current time, that's where I see that, you know what, I've seen the proof, okay? So for that, once you've been there, I got out of the broker-dealer system. I resigned from that and set up as an independent registered investment advisor. For what purpose? So that I could bring those products that would make most sense to me for how I would invest and how I do invest my own IRA money, and how then the expectation would be for others to do the same. So when I work with my clients, this is one of the things. If we're going to be in the market, right, and most are, then it's how to do so. So again, we got another slide on Dr. Harry Markowitz. He was a graduate student, and again, University of Chicago. This is one of the better schools around. We see a few Nobel Prize winners out of there. All right. In 1952, he was the pioneer of modern portfolio theory, is when he wrote his doctoral thesis. So, and again, one that won the Nobel Prize, I'm sorry, in 1990. So. When it comes to it, if we look at this next slide, which is the Markowitz Efficient Frontier, this is what I go over with clients all the time in the office. So if you come in the office, one of the things I'll show you is how portfolio design works in the real world. Okay, so it starts with the Efficient Frontier that Dr. Markowitz put forth here back in 1990, or won the prize in 1990. He was put this out there before then, of course. But what you see is on the far right is the S&P 500 index. The average return over the last 50 years at about 10%, with a standard deviation of 18. That's the risk, that's the volatility. Okay, the higher that number, the more risk you're taking, or the more volatile your portfolio is going to be, and the more problematic that's going to be in retirement when you're trying to take income from that portfolio. So if you notice to the left, a moderate portfolio of 50-50 stocks and bonds could give you a similar return, but with about half the risk, half the volatility, and that, when it comes to stability of income, is so important. So think of it this way. When it comes to the markets, when it comes to investing, what we're going to be, when we're doing comprehensive planning, we're determining what kind of needed rate, what's the needed rate of return to attain and maintain your standard of living, quality of life, no matter how long you live. Add in for fun money, right? We want to be able to enjoy that life, and we want to make sure we never run out. So we determine what's the needed rate of return to accomplish that, and how can we do that with a minimum amount of risk. And that's where this portfolio construction and determining which portfolio is the right one, or maybe a laddering of portfolio, bringing in different hedges to help with the reducing risk further. All of that is part of the planning. All right, I'm going to wrap it up with you when I come back. Join me here. We'll be right back on the Retirement Report.
The time